Here's what's going viral right now. On Wednesday, one company reports earnings, and the entire American stock market holds its breath. August 26, 2026. Nvidia releases quarterly results, and by most measures, no single number matters more to your retirement account. This one stock now carries roughly 7.5% of the S&P 500, among the heaviest single weights the index has ever held. Which means something strange is true right now. If you own a basic index fund, you did not pick this stock. You own it anyway. In the Nasdaq 100, the weight is heavier still, roughly 9%. Concentration has quietly become the defining feature of this market. So here is the uncomfortable question this film asks. Did one company earn the market gains, or is it holding the market up? Wednesday is not really a stock story. It is a math problem attached to millions of retirement plans that never voted on it. 3 questions, then. How did one company get this heavy? Where does the money actually come from? And what happens if it stumbles? Over the next 18 minutes, we trace the chain, verified, labeled neutral. This is the company holding up the entire market. Start with the machine nobody sees, not the chip, the index, and the quiet rule that decides where your money goes. An index fund buys every company in the index, weighted by size. Bigger company, bigger slice of every dollar you invest. There is no analyst in that loop. No judgment. The market decides size, the fund follows, automatically on every single payday. So when one company grows faster than everything else, it does not just win the market. It becomes a larger share of the market itself. And the fund buys more of it. Not because it is good, because it is big. That is the mechanism. Hold on to it. Today, the 10 largest companies make up roughly 37% of the entire S&P 500. 500 companies, 10 names. For most of the past 4 decades, that number sat closer to a fifth. Concentration at this level is genuinely, historically unusual. Before and after, same index, same 500 names, but the center of gravity has collapsed into a handful of them. Round 1 of Guess the Number. Of every dollar entering an S&P 500 index fund today, how much lands in the top 10? Roughly 37 cents. And of that dollar, about 7.5 cents goes into one single company, before you have made any decision at all. None of this is new in kind. Every era has had its giant. What changes is which giant and what happened next. The 1980s belonged to one computer maker. Before that, a single telephone company grew so large it was broken up by court order. March 2000. A networking company briefly became the most valuable company on Earth, worth over $500 billion. It then fell roughly 80%. A quarter century later, that company has still never reclaimed the peak it hit that spring. And yet, the internet still won. The company was real. The revenue was real. The price was the thing that turned out wrong. The 2020s brought another giant, a consumer hardware maker that at times approached 7% of the index entirely on its own. This one got heavier, faster. Market value climbed from about $1 trillion to about $5 trillion in roughly 3 years. Compare the standard index to its equal-weighted twin. Same companies, equal slices. This year, the equal-weighted twin is ahead, by about 3 points. That gap is the entire story in one number. 2 different markets are hiding inside one ticker, and most people own only one of them. To be clear, none of this proves a bubble. It is a measurement, not a verdict. Weight follows earnings, and the earnings are real. Which raises the question this film actually cares about. Where do those earnings come from? Follow the money into the building. Welcome to the machine room, because a company this heavy is never one business. It is one business standing on another. Start where it started. This company spent 30 years selling graphics cards, mostly to people who wanted to play video games. As recently as 5 years ago, gaming was still its largest source of revenue. That is not a typo. Gaming. Then the world discovered what those graphics chips had secretly been built for, and it had almost nothing to do with games. A graphics card exists to do one thing millions of times at once. Multiply numbers in parallel extremely fast. That is also almost exactly what training a neural network requires. Enormous grids of multiplication, repeated until a model learns. The chip built for pixels turned out to be the chip that trains artificial intelligence. Physics first. Strategy came afterward. Last quarter, the data center segment accounted for roughly 90% of everything this company sold. Read that again. The gaming company is now a data center company, one that still carries its old name on the door. Total revenue last quarter, about $82 billion. 5 years ago, the whole company earned a fraction of that in an entire year. Round 2. Of every dollar this company now earns, how much comes from data centers rather than from gaming? Lock it in. Roughly 90% data center. Gaming, the original business, is now close to a rounding line on the same page. And the margins are extraordinary. Gross margin has been running near 75%, rare air for anything physically built in a factory. Margins that high mean one of two things: a genuine moat or scarcity pricing. This company appears to have both for now. The moat has a name, a software layer nearly 20 years old that most artificial intelligence code on Earth is written against. Rewriting that code for a rival chip is possible. It is also slow, expensive, and risky. Switching cost is the real fortress. And it no longer sells chips. It sells racks, entire systems, networking included, delivered as one unit into a data center. Bigger unit, bigger invoice, deeper lock-in. That is how a component supplier becomes infrastructure. And infrastructure is what the index is pricing. So one segment carries the company. The company carries the index. Concentration nested inside concentration, 3 layers deep. But there is a fact about this company that surprises almost everyone. It does not manufacture a single one of its chips. It designs them. A foundry in Taiwan builds them. And the memory that makes them useful comes from South Korea. Which means the ceiling on every quarter is not demand. Demand has not been the problem. Supply is. It always has been. And the tightest link in that chain is not the famous chip at all. It is the memory stacked right beside it. Welcome back. Meet the component that decides how many of these accelerators can exist at all. It is called high bandwidth memory. Here is the physics. Processors kept getting faster for decades. The pipe feeding them data did not. Engineers call it the memory wall. A processor waiting for data is an extremely expensive space heater. Bandwidth, not raw speed, is the binding constraint here. High bandwidth memory solves it by going vertical. Instead of chips spread across a board, memory dies are stacked into towers. Each tower is drilled through with thousands of microscopic vertical channels, so data travels up and down instead of the long way around. Those towers sit millimeters from the processor on the same package. Shorter distance, wider pipe, vastly more data per second. The result is bandwidth measured in terabytes per second, orders of magnitude beyond the memory in the device you are watching this on. Without it, the accelerator does not work at scale. The chip everyone talks about depends on the chip nobody talks about. Now the concentration inside the concentration. Only 3 companies on Earth make this memory at scale. 3. One of them supplies roughly 60% of that market, a Korean memory maker most viewers had never heard of a year ago. In July 2026, that supplier launched the largest first-time listing by a foreign company in US history, about $29.5 billion. Think about what that means. The supplier of a supplier raised $29 billion on the same demand curve. Investors found the choke point. When the market prices a memory maker like an artificial intelligence stock, it is telling you exactly where the real scarcity lives. Reporting suggests this memory capacity is committed far in advance. Suppliers describing capacity as sold out through this year, with next year already spoken for. Then comes packaging, the step that fuses processor and memory towers onto one slab of silicon. Slow, delicate, and capacity limited. For 2 years, that packaging line, not the chip design, has been the hard ceiling on how many accelerators can exist. Round 3. Alongside a single top-end accelerator, how many of those memory towers get packaged? Lock in a number. Typically 8 stacks, and each stack is itself a tower of 8 to 12 memory dies, drilled and bonded together. So one product you hear about contains dozens of chips you never hear about, from companies that quietly gate this entire boom. Map the chain. Design here, foundry in Taiwan, memory in South Korea, packaging back at the foundry, assembly then the cloud. A chain is only as fast as its slowest link. The slowest link, not the strongest company, sets the quarter. And two of those links sit on two peninsulas, Taiwan and South Korea, separated by a few hundred miles of water. That is a geographic fact, not a prediction, but it is the fact sitting underneath a very large share of your index fund. Trace the tree once. Your retirement fund. The index. One company, one segment, one memory supplier, two coastlines. That is the supply side. Now flip it around, because a chain like this only matters if someone keeps placing the orders. Follow the buyers, because here the story gets uncomfortable in a way that most earnings week coverage skips entirely. The company filings disclose it plainly. A small number of direct customers account for more than half of total revenue. Trace those orders upstream and most of them land with a handful of cloud giants and a few very large artificial intelligence labs. Combined, the largest cloud operators have guided to roughly $725 billion in capital spending this year alone. Here is the sentence that matters. Their capital expenditure line is this company revenue line. The same money viewed from two sides. So you are not really analyzing a chip company. You are analyzing 4 or 5 capital budgets and the confidence behind them. Budgets can change, not because the technology fails, but because a board decides the payback period has simply grown too long. Then there is the loop that critics keep circling. The company also invests in some of the very customers who buy from it. Supporters call that ecosystem investment seeding a market. Skeptics call it circular revenue. Both descriptions fit the same disclosed facts. Why it matters? Revenue partly funded by your own investment is still revenue. It simply rests on a thinner floor. Meanwhile, every one of the largest customers is designing its own artificial intelligence chip. All of them, publicly, for years now. They are not trying to eliminate their supplier. They are trying to build a credible alternative because leverage lowers the price. That is the buyer concentration trap. The same 5 customers who make the numbers enormous also hold the strongest hand at the table. There are rival chip makers too and a wave of startups. Market share is still overwhelmingly one-sided, for now. On its last call, management described demand visibility as demand having gone parabolic, with confidence in $1 trillion of next-generation revenue through next year. That claim gets tested on Wednesday. Dominance measured against demand this steep is a strange kind of fragile. Not weak, just balanced on a single assumption. And that assumption is simple. The people buying these chips will keep earning enough from them to justify buying more. Which leads to the quietest debate in this entire sector. And it is about accounting of all things. How many years does an accelerator actually earn revenue before it is obsolete? Cloud operators assume roughly 5 to 6. If the real useful life is shorter, cloud profits are overstated, returns fall, and eventually the orders slow. Quietly, without any announcement. If it is longer, the boom is cheaper than it looks and the spending continues. Nobody knows yet. That is the honest answer. Wednesday will not settle that question. It will move trillions anyway. So here is exactly how that scoreboard actually works. Welcome back. An earnings night has 3 numbers, and only one of them usually matters. Most coverage gets this backwards. Number 1, consensus, the average of analyst estimates. For this quarter, roughly $92 billion in revenue and $2.08 a share. Number 2, the whisper, the unofficial higher bar that traders actually position for. It is never printed anywhere official. Number 3, guidance, what the company says about next quarter. 9 times out of 10, that is the number that moves the stock. And here is the pattern most people miss. This company has beaten expectations before, and the stock still fell the next morning. In February it beat and fell 5.5%. In May it beat again and still slipped. Because the beat was already inside the price. When a stock climbs for months on an expectation, merely meeting it changes nothing. That is why traders watch the options market. Right now it prices a single-day move of about 6 to 7% in either direction. On a company this size, that is roughly $300 billion of market value, created or erased between one afternoon and the next. And because of index weight, a move that large drags the whole S&P 500 by roughly 0.5% on its own. So, 3 scenarios. We are not predicting anything. We are describing the shapes this market has already priced in advance. Scenario 1, beat and raise. The chain validates. Memory suppliers, foundries, power companies, the whole tree reprices upward together. In that world, the concentration deepens. The index climbs, carried once again by an even smaller group of names. Scenario 2, the tricky one. Beat but guide softly. Good news that is not good enough. Historically, the most volatile outcome. Because a soft guide does not say the story is over. It says the slope is flattening, and the price assumed no flattening. Scenario 3, a miss or a supply-limited forecast. Then the unwind does not stop at one ticker. It travels the chain. Memory, foundry, packaging, power, and every index fund holding the top 10. That is what an interconnected market actually means. Notice something. All 3 scenarios are about the price, not the company. The technology is unaffected by Wednesday. Only the math moves. Which brings us to the part almost nobody covers. What any of this actually means for a person who owns an index fund. If you have a workplace retirement plan, a pension, or a target date fund, you are very likely a shareholder in this company. You did not research it. You did not buy it. A waiting rule bought it for you automatically every time you got paid. That is the honest tension inside index investing. You were sold diversification. The waiting rule quietly delivered concentration. Both things are true at once. The fund does hold 500 companies. It just does not hold them anywhere near equally. And be fair to the mechanism. That same concentration is exactly why the last 3 years of index returns looked so good. Concentration is not a flaw that appeared recently. It is the engine that produced both the gains and the risk. One engine, 2 directions. Here is the only actionable thing in this entire film, and it is not a trade. Open the fact sheet for your fund. Read the top 10 holdings and the weight beside each one. That single page tells you what you actually own. History here is reassuring and unforgiving at once. Indexes survived the Nifty 50, the dot-com peak, and the 2008 financial concentration. The index always recovered. What varied was how long it took, and time is the one thing an individual cannot diversify. To be explicit, this is not financial advice and not a recommendation to buy or sell. Knowing what you own is not a trade. So, the verdict on the company holding up the entire market. Labeled to the very end, like every claim in this film. Verified. The revenue is real, the demand is real, and one stock genuinely carries an unprecedented share of this index. Analysis. That weight rests on a handful of customers, a 3-company memory supply, and one assumption about how long these chips earn. Developing everything that moves, the guidance, the price, the weight, will already be different by the time you finish this sentence. The verdict is not bullish and it is not bearish. It is structural. One company has become a single point of failure for a whole market. We audited the biggest listing in history the same way, same rules, same labels. That investigation is on screen now if you want it. Every source here is dated on screen and listed below. Check our math. That is the whole point. This is the viral feed.